When you think of McDonald's, you think of burgers, fries, drive-thrus, late-night cravings. But what if I told you, McDonald's isn't really in the food business, it's in the asset business, and once you understand that, you'll never look at companies the same way again. Welcome to Behind the Balance Sheets, where we break down how global giants actually make their money. Let's start with a simple question. If tomorrow burger sales dropped by 20%, would McDonald's collapse? Most restaurant chains would, but McDonald's wouldn't, because the burger is not the foundation. The land is. The public illusion. On the surface, McDonald's looks like a restaurant operator, over 40,000 locations worldwide, serving millions of customers daily. But here's what separates it from most food chains. Roughly 90 to 95% of locations are franchised. That means independent business owners operate them. They handle hiring, payroll, food costs, equipment, utilities, daily operations. McDonald's corporate, they control the system, and they collect franchise fees, royalties, typically a percentage of revenue, and most importantly, rent. That last piece changes everything. The Ray Kroc turning point before McDonald's became a global empire. It was just a successful burger stand in California, and Ray Kroc almost missed it. In 1954, Ray Kroc was 52 years old. Not a young startup founder, not a Silicon Valley billionaire. He was a milkshake machine salesman, not rich, not powerful, just persistent. When he noticed one small restaurant ordering 8 milkshake mixers at once, he became curious. Most restaurants ordered 1, maybe 2. 8 meant volume, so he flew to San Bernardino to see it for himself. What he saw wasn't just burgers. He saw a system, workers moving with precision, orders delivered in seconds, lines of customers forming without expensive marketing. The McDonald brothers had created operational efficiency, but they were content staying local. Kroc wasn't. He didn't see a restaurant, he saw replication. He saw highways filled with golden arches. He saw scale. And here's what most people misunderstand. Ray Kroc didn't invent the burger. He didn't invent fast food. He mastered distribution, control, ownership. He understood that the real power wasn't flipping burgers. It was owning the system that flipped them, and eventually, owning the land beneath them. That shift in thinking built an empire. The real estate engine. Here's how the machine works. When a franchisee wants to open a McDonald's, corporate often purchases the land or secures a long-term master lease. They control the property. Then they lease that property back to the franchise owner. So, the operator pays an upfront franchise fee, around 4 to 5% of monthly sales in royalties, and rent, often calculated partly on revenue. That means McDonald's gets paid before the franchisee profits, even if the store struggles, even if labor costs rise, even if margins shrink. McDonald's still collects rent. That transforms the business model. Instead of being a volatile restaurant chain, it becomes a cash-flowing commercial landlord with built-in tenants. That's a completely different risk profile. Why land changes the game. Restaurants fail constantly. Margins are thin. Competition is endless. Consumer tastes shift. But prime commercial real estate? It appreciates over time. And McDonald's doesn't buy random land. They choose high-traffic intersections, commuter corridors, urban density zones, suburban growth areas. Every location is data-driven. They analyze traffic counts, demographics, income levels, future development projections. If a McDonald's exists somewhere, it passed a mathematical test. Over decades, that land increases in value, even if burger prices barely change. That's long-term wealth through asset ownership. The margin advantage. Here's something most people miss. Company-operated restaurants produce lower margins than franchise locations. Why? Because corporate absorbs labor and food costs. Franchised stores, however, generate higher margins for McDonald's. Rent is high margin. Royalties are high margin. They scale globally, and they don't require managing daily operations. That's why McDonald's often trades more like a stable real estate and royalty company. Not a risky restaurant chain. Structure determines valuation, and McDonald's structure is engineered for durability. Surviving economic downturns. In recessions, consumers cut spending. Luxury brands struggle. Casual dining weakens. But affordable fast food, it often remains resilient. McDonald's positions itself as value. Value performs well when budgets tighten. Meanwhile, the real estate portfolio remains intact. Long-term leases stay active. Rent continues. That combination, asset ownership plus affordable pricing, creates stability. And stability is attractive to investors. The data evolution. But McDonald's didn't stop at land. It evolved into a data company. Mobile apps, drive-through optimization, self-service kiosks, loyalty programs, delivery partnerships. Every transaction generates data. They know what sells. When it sells, which promotions increase average order size, how pricing adjustments impact demand. This allows continuous optimization, dynamic pricing strategies, localized menu testing, behavior-based promotions. It's algorithm-assisted retail supported by hard assets. That combination is powerful. The bigger lesson. Zoom out. The real lesson isn't about burgers, it's about ownership. Most people focus on revenue. Smart companies build systems. Great companies own assets. The franchisee works for income. McDonald's owns the foundation. Income fluctuates. Assets appreciate. That's the difference. This is why some businesses remain small, while others become global empires. The public sees the product. Investors study the structure. Final perspective. The next time you drive past the Golden Arches, don't just see a drive-through, see a carefully selected commercial asset. See a long-term lease agreement. See predictable, recurring cash flow. See one of the largest real estate portfolios in the world disguised as fast food. Because behind every iconic brand, there's usually a deeper financial story. And that's what we uncover here. If you enjoy these breakdowns of how companies really make their money, consider subscribing. New deep dives drop every week because once you start thinking in assets instead of products, you never look at business the same way again.